Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on GE Vernova, ticker symbol GEV. This video was requested by Joey25675. Thank you for the request, Joey. I'm happy to do a breakdown of the stock for you. GE Vernova is an energy company that works to create more sustainable, reliable, and affordable energy. The company's technologies help generate about 25% of the world's electricity. What GE Vernova actually does: generates electricity, obviously. GE Vernova designs, manufactures, and services technologies for generating electricity from gas, nuclear, hydro, and steam. Transfers electricity. GE Vernova provides grid solutions and software to transmit, distribute, convert, and store energy. Decarbonizes energy. GE Vernova works to reduce carbon emissions through technologies like direct air capture and carbon capture. Electrifies the world. GE Vernova provides electrification software and solutions to power economies and improve quality of life. Improves river ecosystems. GE Vernova engineers design aerating turbines that improve hydropower efficiency and maintain healthy oxygen levels in rivers. GE Vernova has three segments. Their power segment designs, manufactures, and services gas, nuclear, hydro, and steam technologies. Their wind segment offers wind generation technologies, including onshore and offshore wind turbines and blades. Electrification provides grid solutions, power conversion, solar, and storage solutions. One thing I really like about GE Vernova, just off the bat compared to GE as a whole, is that they're only focused on specifically energy. One thing I really hate about GE is that if you're buying into GE, you also have to buy all the garbage that you don't really want in the company because it's such a big conglomerate and they do so many different things. There are often segments that underperform compared to segments that you just want to own. It's kind of like buying a company like Disney, where they have the theme parks, but you can't just buy the theme parks. You also have to buy the streaming services. You also have to buy everything else that Disney does, including the cruises. And I really like that GE spun this off because the management can just focus on energy solutions. I really hate when management teams are juggling all these different segments that they don't really understand because it genuinely is not worth their time to be, experts at energy if they have all these different things that they're doing, like, making washing machines, working on aircrafts, all the million things that GE is involved with. I like that GE is voluntarily spinning off segments of the company to specific companies that are different than just the conglomerate that is General Electric. GE Vernova has had an incredible run in the past year. Currently, the stock is up 187.98% over just the past year. The current market cap of the stock is $104.27 billion, and the price to earnings ratio is 82.61, with the annual dividend yield being 0.26%. One interesting thing about this is because it's risen so rapidly, the beta is really skewed to being a lot higher. So I actually had to use a different working average cost of capital than what I just calculated based off of what I found the beta to be. We're going to get into that in the next segment with the discounted cash flow model and my actual model for the value. But right off the bat, one thing that I think is very interesting about this company is that it's very similarly valued to another stock that I recently reviewed, Equinix. And I think that's because, it has a very high price tag. And the reason for that is that this stock is expected. It's basically baked into the price that this stock has to be able to have the big growth from the demand for AI training. So what a lot of analysts are essentially expecting is that the demand for energy is going to ramp up like crazy with the new AI training, and that this stock is going to benefit from that. So if AI training ends up having lower than expected demanded energy, this stock's in trouble, right? And that's kind of what I've been reading just here and there. But I really like the core business of this stock. I think it's a great business to be in. And from what I've read before, and just in general from researching the company more, it seems like they have a really sustainability is a very important thing for this company. They want to create sustainable energy solutions. So if you're someone who likes green energy, this stock might be for you. Now, I do think that it does have a very high price tag, which I don't necessarily like, but I think that the core business is always more important from an investing standpoint than the actual dollar amount that you're paying for the shares of the company. Because personally, I would rather buy into a company that maybe is more expensive right now, but it can recoup it because there is future growth moving forward, rather than buy a company that's like a cigar bud that Warren Buffett talks about, where it's only good for one more puff, but the intrinsic value is below what it's trading for. So I think that the core business is very strong, but I think it's questionable with the current valuation. However, the recent dip does kind of present an opportunity for if you're wanting to make a play on expected AI energy increases, or just energy demand increases, if you foresee that in the future being above what people are expecting, right? Because with a market cap of $104.27 billion, this is a giant conglomerate of a company. And they have access to a lot of advantages that a lot of other energy companies won't have access to. And I think GE Vernova is set in a spot where if the energy demand is increased, they're going to make a lot of money. Analysts tend to be more bullish on the stock, with 8 rating it a strong buy, 14 of the analysts rating the stock a buy, 7 rating it a hold, and 1 rating it a sell. And the analyst price targets fluctuate between $265 to $500, with the current price at $377.97. The average of these analyst price targets are $415.78. Here is my weighted average cost of capital. I got 10.162%. However, I really think that that's way too liberal of an discount rate or weighted average cost of capital, just because I think that this would punish the stock for having performed as well as it has. And there really isn't enough data, even from Yahoo Finance, to establish an actual beta of the stock. And when I looked it up, it was 2.3, and that makes sense because the stock has performed so well compared to the S&P 500. However, when I went on alphaspread.com for their modeling, they were using a weighted average cost of capital of 7.98%. And while I still think this is pretty high, I think that we can use this number in our model just because I think that it's more fair on the company, and I think that it's more realistic than using the 10.162%. However, you do have to take into account that the risk-free rate is really hurting the valuation of this company because they don't have any debt, so their cost of equity is going to be high regardless. I mean, most companies' costs of equity are pretty high just because of this, insane risk-free rate and the high rates environment that we live in right now. So I think that a 7.98% weighted average cost of capital is a good weighted average cost of capital for the actual modeling. After plugging in our discount rate of 7.98%, it's clear that GE Vernova needs about a 19% average free cash flow growth rate, and I actually think that this is pretty reasonable. Now, here's kind of my conclusion from just the DCF and researching the company and everything like that. I think that GE Vernova is probably very close to fair value, simply because I think that they're going to be able to grow the free cash flow more than they have historically once AI really starts ramping up. And the free cash flow growth rate on average has been 14.05% since 2021. The average revenue growth has been 2.35%, which is pretty solid for an energy company. I also think that they're just a massive conglomerate. And if there's more free cash flow coming in, then they're going to be able to either, one, invest in even more CapEx and just energy infrastructure and drive more growth that way, or they're going to take the retained earnings and return that to the shareholders in the form of a dividend. However, again, this does really remind me of Equinix. You're taking on the risk that if AI energy demand is significantly lower than what analysts or other people are expecting, then you're probably going to get hit with losses. I mean, it's just such an expensive stock right now that it would be unacceptable for that kind of market condition to happen. So if the energy for AI, training is not what people think it's going to be, then this stock is going to be a very poor performer, right? But you do have the advantage of having, just a massive amount of money, a clear balance sheet. I think that this stock, if you hold it from here to 5 years in the future, I do think that you will make a decent amount of money. However, if you're a short-term investor, I would take extreme caution with this stock because it does have a big price tag on it. I actually think, and again, none of my stuff is investing advice, right? I'm not a financial advisor. I just want to make that very transparent. But if I was trying to build a position in GE Vernova, what I would do is I would buy just on the dips, right? Like I would dollar cost average into it. I would buy a little bit, let's say 10% of the money I wanted to put into it, I would buy in. I would wait a little while, maybe a month or two, put 10% more in, and just keep buying in. So then if the stock dips because it is very expensive, or if something short-term happens that hurts the stock, then I think that you should buy into this, right? Now, I think if we use this 14.05%, this is going to be significantly lower than what's going to happen in the future, according to a lot of analysts. And this is why analysts are so bullish, right? Because they're probably expecting an average free cash flow growth rate of about, 20%, maybe 21%, right? I think that's a little greedy, right? I think 19% is probably pretty reasonable, which would put it close to fair value, which really does make sense. But if this stock dips low, I do think there are significant advantages to buying into it, because it has just the advantage of economies of scale, and it's such a big company that I think that they're going to be able to meet the energy demands maybe better than any other company, or pretty much most companies that we've already reviewed on the channel. And, this is essentially like buying an energy ETF. I mean, you're getting a lot of different kinds of energy. I mean, I saw that they're even venturing into nuclear. So you're very diversified if that's important to you. And it's also, again, a very green type of stock. So sustainability is a key focus on this stock. It's part of their mission statement. And I think that that's a cool thing to, be, if you're energy, I guess, sustainability type of investor, that could be a very important thing to you, right? And they've demonstrated that they're able to grow the free cash flow. Now it's positive. So that's also a good sign. They're trending up, which you really like to see. And you can even see that the stock has just soared over the last year. So it definitely is not the best time to be in the stock right now. But I think that over time, this stock is going to just continue to grow. And the present value is just going to increase. So the business is very strong, but the price tag is also very high. So if you're owning this stock, you need to be very sure that future energy demand is going to increase and that they're going to be able to increase this free cash flow. I think that I would probably rate this stock as a hold. So if you already own it, I would just hold it for pretty much forever, because this stock's going to just continue to generate money for you. But I also think that the price tag is a little hefty to be getting in. I think that, and this is kind of liberal still, I think that around a 350 price tag is where I would probably enter in, and I'm going to keep this on my radar just because I think that it's a very solid company. But I just don't think that I want more exposure at this price, because I already own a significant amount of Energy Transfer. I have about $6,000 in it, and I'm not really super excited to get into even more energy plays personally. And this price tag is just a little bit too high for me. And Equinix had the same exact issue, and only time is really going to tell what the fair value should be. But a lot of this is speculation, and I think it might be a better idea to wait it out and kind of see what happens. But you also have to know that you could miss the ship. I mean, the AI kind of boom is really going to help a lot of different companies. And I think it's a solid bet to put money into something like an energy company that could benefit from higher demand from, natural gas and all types of energy that they're going to need for these, AI training models. And just also as infrastructure gets built and as, you know, the United States continues to build up as it always does, there's also going to be a constant higher energy demand over time. And the sustainability factor of this makes it especially lucrative when you're looking at the very, very far future. So I think if you're an extremely long term investor, you could probably buy into this now and not feel bad about it and just hold it for 20 years and you'll probably make some money, right? Obviously, nothing's definitive. It does have a high price tag, but I think that this is a very solid company with a very high price tag. And that's kind of my review. I think it's very close to fair value. I don't think you're getting any kind of extreme deal on this, right? But I do think that it is extremely valuable and that energy companies are going to, they're just going to trade at a premium from now on if they're involved in the AI side of things. And I also think GE Vernova is kind of a special case because they're looking at new energy solutions as well. So if there's a massive breakthrough, there's some surprise upside to this stock. I mean, if they find something or they trademark something or they invent something that could drastically change the way energy is and make it cheaper or better or more efficient, which I think is a huge possibility because of the size of the company, I think that you could make a lot of money if that type of thing happens. I'm not saying it will happen. I'm just saying that there's a greater possibility than a lot of other companies out there. But let me know what you guys think down in the comments section below. Thank you again, Joey, for recommending this stock. It was really fun to review. And let me know if you guys want me to do any kind of stock analysis video.